Morning guys, Joel Frank here, market analyst for YouTrading, and in today's video, it's going to be more of an educational video. I'm going to be talking about how inflation can impact markets across asset classes, but I'm also going to make it relevant to what's happening in the market right now. So before we jump into talking about the inflation data that just came out of the US today, and we can also mention the Eurozone inflation data too, uh, let's just talk about central banks and how they view inflation and how they might react and how that might impact markets. Basically, for major central banks like the Fed, the Bank of England, and the ECB, and all central banks actually, their main job is to maintain price stability. Now, at the Fed, the ECB, and the Bank of England, those banks define price stability as inflation averaging 2% in the long term. Okay. Why do you want prices to remain stable? Well, it allows businesses to plan. It creates more certainty in the future, which enables more investment, which should theoretically be better for long term growth prospects and all that kind of good stuff. So that's why they aim for price stability. Now, in the current economic environment across the world, we've got inflation that is significantly above target. So in the US, for example, the headline CPI reading was, I can't remember the exact number, but the last one was about 8.3%, I think. So well above that 2% target. In the Eurozone this morning, actually, we just had the headline CPI come out and it was 10%. So 8% above target. And, in the UK, it's pretty much just as bad. So what's happening at the moment is central banks are taking steps, as they should be, to bring inflation back down to their target, which is 2% for all the central banks that I was just mentioning. Now, how do they do that? Well, what they need to do is take measures to try and cool the economy, to slow demand, because, when you do that, that tends to have a downwards pressure on price growth, and that means you can get inflation back to your target, or at least that's the theory. But it seems to normally play out that way if central banks act properly. So how do you cool demand? Well, one of the best ways to do that is to raise interest rates, because that means that it's more difficult, or it's more costly for banks to create new loans for the people that are borrowing. So it reduces the demand for fresh money in the economy, basically. People that already have debt that's at a variable rate, perhaps that's on mortgages or other form of payments. It could be on anything really, or the government that's borrowing from the public. Their debt burden, or the burden of their interest rate payments anyway, goes up. So all of this has the effect of pretty much slowing the economy, because it means people are able to borrow less or have to pay back more, which should theoretically, like I'm saying, theoretically dampen inflation. So, how does this impact markets? Well, I mean, it does depend, but the general rule that you could say is, in an environment where interest rates are going up, let's talk about in the US, for example, where interest rates are going up because the economy's hot, inflation is hot. Um, you could potentially see a scenario where the dollar is strengthening, which it has been, where US government bond yields are rising, which they have been. And if there are concerns about how this tightening might cause a recession, and concerns and uncertainty about how high interest rates might actually eventually go, then that can also weigh on stocks, which this year it has been. But let's talk about today's. Like that being said, now we sort of have this basic understanding. Let's talk about today's US inflation numbers. Okay, so we had the Core PCE price index. Now this is not the most widely followed measure of inflation by the public in America. But it is the most closely followed measure of inflation by the US Federal Reserve. They seem to think that it's the most accurate measure of underlying price pressures in the US economy. And you can see here that on a month over month basis, it was higher than expected. Prices rose 0.6% in August, a little bit more than the expected 0.5%. And on a year over year basis, also hotter than expected. Prices up 4.9% in the last year, according to this index, above the expected 4.7% rise. And you can see here that the July number was actually also revised a little bit higher from 4.6%. So very much in fitting with the fact that inflation in the US remains hot. In particular, core inflation in the US remains hot. So what does that mean? Well, it strengthens the already very strong resolve that the Fed and the Fed policymaking officials have to continue with their aggressive interest rate hikes to bring this inflation back under control. Okay, now let's have a look at the market reaction. We'll go on 1 minute candlesticks. Now, I wouldn't be trading on this type of time frame, but it is useful to sometimes look at how markets were reacting. And actually, the dollar was choppy. I mean, what you would normally expect when it's hotter than expected US inflation is for the dollar to rally, but it didn't seem to do that. It seemed to go sideways. Let's have a look at US stocks. You would expect them to have potentially fallen, which, yes, they have. Only a little bit. And then we could potentially look at gold as well, which you probably would have expected to have fallen, which it did for a little bit, but actually now it's a little bit higher. So the very, very short-term market reaction, quite inconclusive, I would say. And that's the thing with markets and economic data. It's never black and white. It's never like, oh, if the data is stronger than expected, then this is definitely going to happen. But what I would say, and that's in the short term, but what I would say in the longer term, this inflation data will probably reinforce some of the themes we've been seeing in markets. So let's go back to the Dixie again, and we'll go on a 1 day. Now, this is the kind of time frame that I really like to look at markets from because it gives you an idea of the bigger picture of what's happening. So we've got these 1 day candlesticks here. You can see that the Dixie has been going up solidly for like a year and a half now, or even more than a year and a half. And this year it's up a lot. Like, where did it start the year? It started the year around 95 and now it's at 112. So yeah, massive rally. But you can see at the beginning of this week, it got into overbought territory. Look at this. The RSI reached nearly 80. Now the Dixie, when it gets that overbought, let's just look in the past. Like it was overbought in mid-July and then it fell back. It was overbought in May and then it kept going a little bit, but then it sort of fell back. So, people booking profit on their longs has the potential to suppress the Dixie in the medium term. But I would very much expect that this uptrend that's been going on pretty much all year and actually even accelerating in recent weeks is not over, in light of inflation data like that, which suggests that the Fed's going to continue going hard. I would expect that, yes, the dollar's going to continue going higher. And I think traders are probably going to be looking to buy dips. Like if we can dip back to this 110 support area here, which also coincides with the 21 DMA, which is there in blue, that could be a nice entry point. Let's look at stocks on a longer term horizon. You can see that we're just above these annual lows here on the precipice of going below 3,600. And, sadly for the equity bulls, yeah, we're testing this support area here from back in December 2020. Sadly for the equity bulls, I think, in light of everything pointing towards a more hawkish Fed, that's going to continue to put its foot on the brake of the economy in order to get that inflation down and risking a recession in doing so. I think, this downtrend has got some legs to go. Maybe there can be a bit of a short covering relief rally. Maybe we can at some point get back to test areas of support and resistance like this one here, just above 3,700, or maybe even a little bit higher. But I think this downtrend would continue given the current inflationary environment. And I'd say probably the same for gold as well. So gold tends to be affected badly when interest rates are rising because it basically increases the opportunity cost of holding an asset like gold that doesn't pay any yield. The higher yields go, the more you'd want to have bonds, so you're getting an actual income from your asset that you own. That's kind of the thinking there. Although, to be fair, if we do slump into a US recession, then that could potentially give gold some reason to rally. But look at this resistance area here around, what is that? Around 1680. and then there's a 21 DMA. It's going to be tough for us to get back above there, I would think. And, there's a risk that gold can fall back and test these lows again. But anyway, guys, I hope this video sort of shed some light on how inflation can affect markets and what's going on in the current market. And I will see you all in the next one.